Hey, everybody. Welcome to the morning market briefing. It's Tuesday, July 21st, 2026. Hope you're doing well out there. We are really jumping into earnings season pretty aggressively here, Ben. Busy week, lots to report on. But it seems as if at a high level, the core economy plodding along, motoring forward.
It certainly is. And I kind of structured this today. We can just kind of have a conversation about some of these. I think the best chart that maybe you can put up, Hicks, is the one on 3M. 3M's up about 6 or 7% this morning. Remarkable acceleration, specifically in the safety and industrial space, which is a very broad, industrial adhesives, tapes, accelerated massively, 8.2% year-over-year growth. That's pretty much unprecedented in the last 5 years for them, and they've been trundling around 0, 2, 3, 1. And now you just throw up an 8. Personal safety was very strong. Auto aftermarket was a little bit weak. Auto was just generally soft in general. We saw that from genuine parts as well. But I think that this speaks to the idea that despite everything that we're seeing this continued cycle, and the cycle is incredibly. It's like a train. Once it gets going, it's very difficult to slow down. It's very difficult to start, and it's very difficult to slow down. And it doesn't accelerate with a ton of momentum, but that momentum is very powerful and just keeps chugging along. And so that's what we're seeing there. We're seeing the same thing at Steel Dynamics. They said, and I thought this was interesting. We'll talk a little bit about the federal fiscal policy and trade policy as well as we get into some of the auto companies. But I thought this was interesting from Steel Dynamics. They said, we continue to see an improved steel market environment supported by domestic trade actions, manufacturing reshoring, infrastructure program funding, and the increasing regionalization of supply chains within the United States. And I think this is something that we had talked about for a while. About, is this actually going to bring manufacturing and industrialization back into the U.S.? And Steel Dynamics is saying that it is. 3M is implicitly saying that it is. And I think these are two real bellwethers that we can look to. Genuine Parts Company was a little bit weak, mostly on their auto business, but industrial accelerated from 3.9 to 6.1%. So they're saying the same thing. A little bit different markets, but overall quite good. So that's what we're seeing on the core economy, and I think that that's good news. And a little bit, I think the narrative was that there was a hope that this might be taking place, and I think there's still a little bit of skepticism that it's durable. But these companies saying that it is.
Yeah, it's interesting, and I think I'll tell you this. I was talking with a super user last week, frustrated by some disconnects in the things that we were saying in terms of inflation and pricing things. It's interesting to hear Steel Dynamics specifically talk about kind of the regionalization efforts that are starting to show, because we've seen these disconnects as a byproduct of some of the tariffs that still remain in place, some of the challenges that that's presenting. Even though demand may not be there, supply is not quite picked up to where it needs to be in utilization. But when you read a report like that from Steel Dynamics, it seems to suggest like, hey, we're getting there.
Yeah, and I think steel prices are going up, but I also think that you're seeing that provide an incentive for more domestic manufacturing.
It's just not a switch.
Right.
If utilization of these manufacturers was low prior to early 2025, for instance, it takes some time to get there, but they're now seeing why they should get there.
Well, and it's utilization. It is also the fact that there was atrophication over the last 15 years where they said, why are we going to continue to invest in, why would you invest in a steel plant? You had leaders of the country telling you, don't, that we're not going to do this anymore. And so why on earth would you do it unless you were just an idiot?
Yeah.
At least that was the conventional
Shout out to
thinking.
the dum-dums.
But the dum-dums are having the last laugh now, because if you did have capacity and you kept it in good shape, then you're doing quite well. Capacity utilization did creep up into the low 80s, low to mid 80s for Steel Dynamics, from the mid 70s over the last 12 months, and even in the last quarter. So you're seeing that capacity utilization increase. But the problem is, I think a lot of capacity has been taken offline.
Yep.
And so that needs to be added, which requires more steel. So I think it's going to be this little circle, but
think of the train, maybe even more
Yep.
so than the circle. Hey, it's starting to move. It's going to take a lot to derail it, but is it at max speed right now? No.
right.
Interesting. Good stuff. What else are you seeing thematically?
So I think on the financials, Tom, I'm curious your thoughts on this, but on the insurance side, we had W.R. Berkley report earnings, and they're seeing pricing come down on some of their insurance products, specifically their reinsurance products, and specifically on their property. We've talked about property before in terms of as the price of as the value of the property comes down, but they're even seeing rate come down a little bit on that as well. Overall pricing was up 3.8%, which seems like pretty good inflation, but that's down from 7.2% just last quarter. And I think this is the bearish narrative around the insurers, if there is one, and that is pricing is going to come down. And I think the more that they make money from their investment books, the more that rates are at 4.5% and they can clip massive coupons, the more that they can subsidize, the more that they just want volume. The more policies they write, the more money they make just on the float. And I think that's really something worth considering, because up until now, they've made money both on pricing and on the float on really high interest rates. But I think that's starting to get competed away. And if that gets competed away, I think that means lower prices on insurance, which is good for everybody. But it might mean a little bit more a struggle for the stocks, which have outperformed dramatically on a year-to-date basis and over the last couple of years.
Yeah, I mean, you really saw the pendulum swing. On one extreme, they could just raise prices all they wanted to because home prices are going up, auto prices are going up. They could just raise and raise and raise and raise. And they didn't really have the investment books to cover that, so your premium had to cover that. Then we kind of swung the other direction. And for a brief period of time, you're right there in the middle.
They can do both.
Yeah, they can do both. And now you're seeing the assets that they're covering starting to lose value. I mean, we talk forever and ever and ever about the housing market, but you can't just keep raising insurance rates because the cost of housing is going down, and it's going down faster than stated, I would argue. So now for a brief period of time, you're in the best possible position where you're insuring assets that are losing value, and you're being able to take those premiums in and invest them in assets that are losing value as well, the bond market, and you can really build fat margins. But I think that you've gotten to the point now where again, we talked about this last week. Margin is sometimes a vulnerability. If there's too much margin, then someone can come in and undercut you, and that's, I think, where we're going to get into. And too much competition is not necessarily a good thing.
I think we might be seeing that in credit cards as well. Synchrony, which is a notoriously so basically they partner with retailers and a large part of their business, and they're the ones that'll be your financing provider if you finance furniture or things like that.
Engagement rings.
Exactly. And they saw incredibly good volume, and they saw much better credit quality. Delinquency rates were down significantly. We have the chart on that, Hicks, as well. I mean, they fell 38 basis points quarter over quarter. They fell year over year as well. So the more that we see credit quality improve like this at the low end, the more there's going to be a land grab for companies to say, "Oh, I would underwrite that risk at a 4% 30-day delinquency rate, and I can get 12% rates on it. Yeah, sign me up for that." And so I do think that we're seeing this land. We're seeing it in Charles Schwab. Schwab down 3% today. We kind of knew what their AUM, but a little bit of the flows was a little bit weak, I think. So we're seeing a land grab in the financial industry, whether it's insurance, whether it's asset management, whether it's credit cards, and I think that we're in the early stages of it, but it's something to watch going forward. And I think that's good for consumers. I think that you bring it to the excess, and it's 2008, but this is not anywhere close to 2008. I think this is more like 2001, 2002. But it's something to watch.
Yeah, I mean, you don't think of it this way, but finance is a commodity in the same way that every bottled water is the same. Every loan is the same. You know, you might just see, how can I get an extra 5 cents off and get it a little bit cheaper? And once you start taking that to extreme levels of competition, then the people making bottled water don't make any money anymore. And so that's why, I mean, you see so many car insurance commercials, because they want you to feel like the one brand has more value over the other. But Geico and State Farm are essentially exactly the same company, and there's no differentiation whatsoever. And once you realize that, then you're just going to take the cheapest option. So, I mean, loans are like that. Banking is like that. It's all the same. There's no differentiation between financial services, especially at banking. So, you know, unless they make you feel like you're special, like Goldman Sachs
or Narwhal Capital.
Oh, yeah.
Yeah.
But
Yeah,
I mean, it's,
for
you
sure.
know, you've got to be able to dictate value in a different way,
Yep.
not just by the raw materials.
The one thing that stands out to me on the Schwab report is their pledged asset line, which if you're a client, you may or may not have one. Most clients are eligible for one if you custody there. I'm certainly not selling you on one. It's a Schwab Bank product, not something that we control. But they've made such a conscientious push on that at every conference. And Schwab, again, the largest custodian for independent advisory firms like ours, they've made such a push, and I'm so tired of hearing them talk about it and how quickly they can open one. And these are essentially lines of credit secured by your investment portfolios, but total balance is up almost 60% year over year. So $33.4 billion on those pledged asset lines. I'm curious, Ben, how do you, and I'm not concerned about that number being up so much. I view it very differently than I would credit card balances or credit card delinquencies. I do think there's an element of, given the security and the relative sophistication of the product, I think it's a bit of a more discerning market perhaps than a credit card user that gets a credit card and doesn't really know what's going on. And there's certainly been a big push for it. But do you see that as any sign of weakness, the fact that that number is just ballooning?
It's very interesting to me. I think, so first of all, Schwab measures its assets in the trillions. So $33.5 billion is like, okay, let's put this in context. But $33.5 billion is a lot of money. And
it's generating a lot of interest.
It's generating a lot of interest, and it's among a investment group that is probably relatively high net worth. And so it's curious to me. I mean, I think there's a big tax implication for this as well. Like, you don't want to sell and take realized gains. But the more the pledged asset lines are drawn down, the more you start flirting with margin calls if things start to sell off. And this kind of speaks to the leverage in the system. Again, $33.5 billion in and of itself is not crazy. But, I mean, the SpaceX IPO was $80 billion, and that was when people were saying, man, this is nuts.
Insane. Yeah.
So if people were forced to sell that amount indiscriminately, and it's not just at Schwab, it might be at Robinhood, it might be at Fidelity, it might be at a lot of other brokers, then you could really create a cascading effect if the market did sell off. Again, I'm not saying that we're there, but it's notable. And 60% year over year increase is certainly more eyebrow raising to me than the $33.5 billion.
I would agree with that. What else are we seeing?
So you mentioned cars, autos, at least auto insurance, but on the autos as well, GM reported. And this is a place where we thought, so again, the inflation has come in pockets. I think steel is up, the copper's up a lot, but not car prices. And this is something that, I mean, people thought that they were going to be buying their Toyota Camrys for $120,000, and that's not what we're seeing. In fact, GM was talking about its pricing. They did upgrade its pricing for this year from 0 to 0.5% to 0.5%.
Yeah. So huge inflation coming through.
So I just think that's noteworthy, simply because we were told all these things. We were told your cars were going to cost $150,000. Your iPhones were going to cost $20,000. Your Oh, we're going to go into a 35% Great Depression GDP contraction in 2020. We're told all these things. We're told steel's never going to come back to the U.S.
Yeah, that's the underrated piece is not only are they not increasing in price, but also we've managed to revitalize the steel industry in this country simultaneously, which means that in the future, the prices might actually come down because we're not going to be buying the tariff steel anymore. We'll be producing it internally, and the prices will go down even further. And there's a benefit to GDP from the jobs created by the steel industry that are not jobs in, name a country.
And I think it's just it's a great reminder to say, okay, think with your head, not other people's heads, and make the right decision, because no one knows the future, and we would include us in it. We are in a very advantaged position. I was talking to a buddy of mine who makes big decisions for a large company, and he said, why does the financial industry can change their mind so quickly? Like one time they think that this is going to be the greatest bull cycle in the history of the world, and the next moment they think it's going to be the greatest bear cycle. And I say, you can afford to do that because all you have to do is press a button and buy or sell. Like when you're actually making management decisions, strategic decisions, you've got to be very confident, because that involves layoffs, it involves massive plant expansions, things like that. So it's a little bit of a side note, but my point being is that we are in an advantaged position, which allows us the flexibility to change our minds quickly. And so I think regardless of, you got to have a view, but also be willing to change that view. So if your view is that GDP is going to contract by 35% in March of 2020, then be willing to change that view a month later when things open up. And I think the best investors are able to do that.
Mm-hmm.
And
I think,
yeah,
I was just going to say the whole thing behind the tariffs, I think, is that strength is never a weakness and weakness is never a strength, right? And we were attacking the world, attacking the economy with a level of weakness and meekness that didn't make any sense. We have the biggest and baddest economy in the world, and our response was, well, we don't want to hurt Europe's feelings and we don't want to hurt China's feelings because like they're making a lot of good money on our people, and like it would really hurt their feelings if we decided to stick up for ourselves. And like what's the advantage there? And so you go from strength to strength by saying, hey, we're going to put ourselves in a position that puts us under pressure for a short period of time, and we're going to become more robust as a result. It's kind of like I can lay around on the couch all day, or I can go do some squats, and squats are going to suck, and you're going to be crash landing on the toilet for the first week when you just get that insane soreness because you haven't squatted in a while. But in 6 months, you're going to be a lot stronger, and that's the position we're in now. For a couple months, we were crash landing and trying to get up and down the stairs sideways because we're so sore. But now we're much better, in a much better position a year and a half later than we would be, and looking to build strength is always the right option. And I think that people I don't know what it is about the idea that we need to kowtow to other countries and be like, oh man, like they're better than us. Look how terrible we are. But we're not terrible. Where are their iPhones, Where are their SpaceXs? That's all there is, Like we make so much money that we own all their Swiss watches, Not me personally. I think that's a bad and poor investment, but maybe one day.
We'll get there someday.
But SpaceX, that's an investment people made a lot of money on, and they forewent many Swiss watches to get those opportunities.
D.R. Horton, interestingly, bringing guidance down. I certainly would not say that is in opposition to our general view of housing, but given that they came in relatively solid, that is surprising.
Yeah, they had a great quarter. They came in at the top end of the guidance, and they cut their numbers for the year. The stock's up. And I think this just kind of speaks to the narrative of where things are. The narrative on home builders right now is about as bad as it's going to get, and they're just going to bounce along the bottom for a little while, and importantly, they're still profitable, but volume is very, very weak. And so if you're Kevin Warsh, I hope you're paying attention to this. I hope you're paying attention to GM and the pricing. I hope you're paying attention to D.R. Horton and the lack of investment there. And I hope that you're willing and able to change your mind, because he's more like us. I mean, he is in a position where he can change interest rates every 6 months, every 6 weeks if he wanted to. And I think that the Fed has been in this dogmatic view of we're going to go through a hiking cycle, and then we're going to go through a cutting cycle, and then we're going to go through a hiking cycle, and then we're going to stay. And I think that having that flexibility is actually valuable and allows you to make better decisions. So hopefully he's paying attention to that. Then just kind of the last few things on narratives. The narrative on AI disrupting some of the data vendors continues to be the case. MSCI and Equifax both down double digits this morning. The quarters were fine. They said AI a lot in their press releases.
Didn't help.
Equifax actually talked about their EFX.AI capabilities and AI-driven operations, all leveraging our cloud technology investment and patented EFX.AI products. So they used it twice in one sentence, EFX.AI specifically, and then MSCI also talking about AI. They should just change the name of the company. But regardless, I mean, that they're not able to fight against that narrative, even though the numbers were fine. So it's a sell on the news event for them. It's a sell on the news event for Danaher. They're down 10% pre-market. They provide a lot of pharmaceutical equipment, and no one's investing in biologics right now because everyone's investing in GLP-1s, and people are going to be healthier, and they're not going to need new biologic drugs. They're going to be on the peptides, and they're going to be healthier. And I think that's the narrative that's driving there. And then a lot of people have been asking about, should we just buy energy and defense companies because of the war in Iran? And the problem is it's not always that easy. Northrop Grumman had a big backlog increase, but their cash flow is weak. You're seeing a lot of changes at the Department of War and then the procurement process, so they're not doing as well. I think they're down pre-market. And then Halliburton as well, which is the big oil field servicer. They didn't really see any improvement at all, despite the Middle East tensions over the last few months. So I think just on one hand, be aware of the narrative, I think would be my advice. And certainly don't chase that, because that can get you in trouble.
Yep. Cool. A lot to digest. We'll wrap it up there. Hope you guys have an awesome day, and we'll talk to you soon.